Welcome back to the Dividend Diplomats YouTube channel. You've got Bert and Lanny, your favorite dividend investors out here in all of media, guys. We're here to talk to you about 5 common mistakes to learn now about dividend investing.
Smash that subscribe button, everyone. Give this video a thumbs up. Holler at your boys, the Dividend Diplomats. We are pursuing financial freedom. We are trying to retire early by growing our passive income stream, by buying dividend stocks, by building our dividend income stream, and then watching that dividend income stream grow over the years. But you also learn a lot over too. So that's what this video is going to be geared towards.
Money doesn't sleep, guys. Neither do we. We're filming this here
Diplomats
on
don't sleep right now, I think is the key to
no, especially you.
this.
Um, June 8th filming, 10 o'clock right now, guys. 5 common mistakes. Now, these are stuff that, Bert and I are going to chat about, kind of give our thoughts on each of these 5. Again, we're trying to make sure you guys avoid these if you're just starting out in your investing journey. Some are going to be no duh, like no piece of no, but some of these are really, it's like, hey, if you're really starting out, this is stuff that I know I would have really taken to heart a couple of these as I was investing, because you kind of lose sight on the bigger picture, and you might end up in a big mess 5, 10, 15 years from now.
100%. And a lot of these are coming from experiences that we've had too. So, no, we're not just pulling these down because we think this is what you should know. This is stuff that we have learned along the way through our blood, sweat, and tears and a lot of our mistakes.
The sweat, the tears.
Yes.
So first one, we're going to get like the easy one out of the way, which is don't chase yield. Again, it's common, it's pretty well understood that you shouldn't go for the highest yielding stock because, the big question is why? Well, it's the sustainability of that high yield. Is the market telling you something that, you don't know, but they know? Bad earnings, maybe they have too much debt, maybe cash flow is strained, so the stock price plummets, yield is high. Oh, look, they've never been this high of a yield, so let's grab them now, only to see the stock price continue to plummet. And then what happens usually to that dividend?
That dividend gets cut. I think this is an excellent first lesson, and this should be the very first thing. Is I've learned it painfully too. I've tried trying to buy those dips, Lanny. Everybody wants to buy that dip and get the recovery and then see a stock take off. And for every success there is on this, there are 20 companies that have cut that dividend. And I know for me personally, when I see a yield that's too high, especially among its peers and its historical mark, it is a red flag for me to at least conduct heavy research on that balance sheet, heavy research on what's happening with free cash flow to make sure a dividend cut isn't cut.
Yeah. The recent one obviously being probably what Walgreens and Leggett and Plot, probably 2 recent ones.
Absolutely. And those are ones at various degrees of different turning points in their stories where
I'll finish my story.
yeah, they're still looking to finish that story. But yeah, you can run into a situation where the high yield gets high, or even to a variant from this, Lanny. You have a great stock here that's at a yield of 4%. Let's just pick, say, Realty Income, a REIT that's REIT that's at 5%. But then you're going to have this litany of REITs that are at 10%, 15%. You're like, why would I invest 5% at Realty Income, a dividend aristocrat that's increased that dividend for all these years? Or there's 10 to 15% over here in this REIT that's only done it for 2 to 3 years before.
Shiny, the red horse, the shiny diamond right there, guys.
Exactly.
Only to find out that diamond breaks less than 12 months, 2 years. Maybe it does last for 3 years.
Maybe.
But then all of a sudden, inflation happens, high interest rates happen, can't sustain the dividend. First thing to usually go is that.
Yeah.
Management does everything they can, and they'll tell you out of their ass that they'll keep it, but can't trust that either.
No, no, that's the bonus lesson. Don't trust management.
Exactly.
Yeah.
So that's number 1. Don't chase yield. But number 2 in the 5 common mistakes to learn now about dividend investing, all companies that grow their dividends every year don't always grow them that next year.
Mhm.
So, that's usually one of Bert and our favorite metrics to look at the dividend growth. They need to have a growth streak before you invest in them. It could be, some easy examples such as Oh, here's a great one. Paramount, aka Viacom. They had a few years of growing the dividend. And I was like, yeah, this is great. They grow it, 20% usually sometimes. Well, sometimes they didn't grow it.
Mhm.
And hey, sometimes they end up cutting it. So it's already painful when they don't get that dividend increase, but that doesn't necessarily also mean that just because they've done them in the past that they're going to do them in the future.
Yeah. 5 years ago, another example for me is 3M, ticker symbol 3M, the Dividend King, the diversified conglomerate that was you thought would be insulated from
Decades
any.
and decades and decades.
Yeah, they were a king. They're not a king anymore because they ran into issues. Their lawsuits took up too much and the growth stopped. Yeah, they're back to I think one now. They've increased it for 1 year. They're working their way towards becoming a dividend king. But that streak that you thought was going to be tough to beat, like Undertaker, easily got beaten down by Mr. Market when the situation changed going forward.
Shell was also another example during COVID, took their legs out. Shell, they stopped growing their dividend leading into COVID. Then they had to cut it. Now they're trying to get back to even still, guys. So past history of growing dividends doesn't actually predict that they will. Gives you a good sign that they will, but it's not 100% certain, guys. So really do your homework, really look at the quality, look at the balance sheet. Have they gone through the tough times? Just really look at it. But what about number three?
All right. This is one that is very interesting and one that I still am learning as we go along with here. It's don't sleep on total return. Dividends are great. The yields are great, but appreciation is also nice too. That is the third leg of the stool here, where you want to see the stock price grow and you want to see the stock price appreciate. When you're chasing yield, when you're chasing financial freedom, you're chasing that income stream growing right out of the gate, it's often easy to focus on how much your income you're getting today and how much income is growing today from the dividend standpoint, but you miss the appreciation of the stock that's also happening at the same time.
Yeah, again, you got to really look at the 5, 10, or as long as you can charts. Compare it if you want to the S&P 500 or to another competitor maybe in the industry to see how they really stack up. Not saying you necessarily have to beat the market with the stock. Obviously, everybody's intent is to do that. Some good examples, I don't know, of this is maybe Hormel. It's like, oh, look, the stock price was down, let me grab it while they're in the mid to upper 20s. Well, that stock has done absolutely nothing. Dividend, oh, they pay a dividend, they grow the dividend every year. Pat on the back, right? Well,
Yeah.
the dividend is still, yeah, it's over 3.5%. Dividend growth had 2 to 3%. So, and they're not returning. So, really look at what the future can look like. Look at how they've done, as that'll give you a good window to the future.
I think that's an excellent example. It's a perfect one for the spirit of what you're trying to hit here with number three. Number four, we're going to take a little bit of a pivot here. Start talking about taxes here, Lanny. Let's start talking about taxes for dividends because all taxes for dividends aren't the same, right?
Exactly. They're not the same. And we're not saying don't invest in the dividend stocks because obviously we are. We're trying to get to financial freedom sooner by living off of dividend income as the best source of passive income. But you have to understand taxes with the dividend. Why buy a REIT that yields 2%? You know what I mean? Because or why buy a business development company that yields 2 or 3% as well? The reason is because those dividends are taxed at your ordinary or higher, usually your higher tax rate. That's your ordinary income tax rate. So, don't just start plotting them everywhere, which way, twice on Sunday, because you really need to make sure you're getting paid to hold a little bit extra um, tax implications when it
Yeah.
comes to those types of stocks.
And to add a layer to that too, I know there's a lot of dividend focused ETFs there that throw in options, that throw in all different kinds of
Mhm.
strategies where those yields look great on paper and the ETF looks great. But you really need to peel back and make sure that the income, you understand how the income from those funds are getting taxed too.
Yeah, whether it's a return on capital, a distribution, or just, again, a dividend that's taxed at your ordinary income rate. Now, understanding taxes can also be a great thing too. I mean, again, qualified dividend, is one from a normal company like Johnson and Johnson, PG, Pepsi, you name it. It's taxed at your long-term capital gains tax rate or a lower tax rate. So just understanding the taxes for dividends.
Yeah, absolutely. Last, but definitely not least on this list, is expecting to get rich quick with dividend investing, Lanny. But then you stop when you realize it's a marathon and it's going to take a long time to reach the top of the mountain.
Yeah, and this is kind of a two for one. One is making the mistake that, oh yeah, like I'm doing this to get rich quick. I'm gonna buy all these stocks that yields 10%, 20%, hits off on all these other mistakes. Or you're just buying the normal blue chip companies thinking that, oh yeah, 1, 2 years I'll be done. I'm buying all these great companies. So don't expect that. We're here telling you, waving the flag. It's not how it is. And then also the other mistake is once you find that out, you stop. You either stop investing or you don't give it enough time to really see the fruit from this type of investing.
Yeah, because we will tell you we were just as excited to see our income grow from $2 to $4, $4 to 10, 10 to 20, 20 to
Yeah,
you guys get
getting
the
in the
idea.
hundreds,
Right.
climbing into the thousands, and now we're in the tens of thousands each.
Yeah. And if we would have stopped back then, Lanny, we wouldn't be here right now talking about this. And I couldn't be more thankful that we just kept going. We kept pushing ourselves to do it and celebrated each one of those little small milestones along the way. And we didn't give up because they weren't thousands of dollar dividends right out of the gate.
Exactly, guys. This is a long-term game. So making the mistake that you think that dividend investing is gonna change it'll change your life. Don't get me wrong. It changed Bert's life. It has changed my life. Oh my God. Like this is the path, at least for that we're taking. Um, but it's not going to be a tomorrow, a 1 year, 2 year, 5 years.
Mhm.
I mean, I'd argue that you can reasonably get to financial freedom within 20 dedicated years of dividend investing. Maybe earlier if you bring in that much money and you have that great of a budget from an expense standpoint. But it's going to take some time. It's going to take years of consistency.
There's no instant gratification with dividend investing. That is for sure.
So that's the 5 common mistakes, guys, that we really wanted to have a little fireside chat with you. 1, don't chase yield. 2, all companies that have grown dividends every year don't necessarily mean they'll grow it that next year. 3, don't sleep on total return. Bert, what are the last 2?
Understanding taxes for dividends is number 4. Last, expecting to get rich quick with dividend investing and then stopping because you don't.
That was the 5 common mistakes, guys. Bert, could you relate to all of these at all?
Absolutely. And I would argue almost all of you have probably related to these at some point too. And if there's a perfect investor out there, we'd like to meet them because everybody makes mistakes and everybody learns and everybody grows along the way.
Yeah. Let us know what other mistakes that you would notate as being a dividend investor, those that have been on the path for years. What other questions do you have about dividend investing? Maybe we can deep dive into a topic. But yeah, like this video and subscribe to this gosh damn channel, guys.
Remember, you're either with us or you're against us, Jack.
That was Bert the Herd and Laney from the Dividend Diplomats. Over and out.